Hello, welcome back. We are finally done with this course. We are actually going to be covering the last chapter, which is chapter 11, and it's going to be about current liabilities and payroll. So, this is actually one of my favorite chapters. I hope that you enjoy it as well and that you end this course on a positive note. And so in chapter 4, you learned about current liabilities and you were asked to record transactions based on different liabilities that a business can deal with. These liabilities were all current liabilities because they were debts that were due to be paid within 1 year or operating cycle, whichever comes first. Debt that is due more than 1 year from when it's incurred is considered a long-term liability. So in chapter 4, you learned about notes payable, accounts payable, unearned revenues, accrued liabilities, salaries and wages, and interest payable. So you're probably wondering, we already covered this in chapter 4, why are we covering this again? Well, in this chapter, I'm going to cover one step further, and that is because typically liabilities come with strings attached. So, for example, when you take out a loan from a bank, it usually comes with an interest attached to it, and that is going to be your string that is attached. So let's look at this example for notes payable. In this example, it is a short-term loan with interest. So a business, let's say your business, applied for a $100,000 loan, and the bank approved it at 12% interest, and it must be paid in full at the end of 4 months. So in this case, the approval or the day that the bank gave the check to your business was January 1st. So technically 4 months later is going to be February, March, April. It's going to be due May 1st. So what we need to do is we need to record the transaction that we received $100,000 in cash due to the loan that we applied for and it was approved for. And the way that that transaction is recorded is you have to debit the cash because we are receiving cash, so it is increasing the cash account. And you do the debit for $100,000 and you credit notes payable because we need to record that we have an obligation to pay to the bank. So notes payable is also going to be increased. And once again, if you need to know why I'm debiting or crediting, you need to refer back to that cheat sheet, that table that tells you whether you increase or decrease an account based on the accounting equation. Okay. Now, we know that the bank will charge 12% interest for this loan. So what we need to figure out is how much that 12% is going to be. And we do that by multiplying the note's value or the loan amount by the annual interest, which in this case is 12%, and by the term of the loan, which is in this case 4 months. And when you multiply these three values, that is going to give you your interest. So as we can see here with this example, our note value is for 100,000. You're going to multiply it by 12% or 0.12 in your calculator times 4 twelfths. Why 4 twelfths? Because you only have 4 months for this loan out of the entire year. That's what the 4 twelfths mean. And if you multiply those three values, you're going to see that your interest for this loan is going to be a total of $4,000. Okay? So, in chapter 4, you learned about, actually, let me just finish this here. So, what we're going to be doing here is we're going to be recording, um, we're going to be recording the accrual of this interest. So, you know that the interest is going to be $4,000. So the bank will charge $4,000 for this loan at the end of the 4-month period. So what we need to do is we need to record the accrual of the interest the day before the payment is due. Remember that our loan was disbursed on January 1st. So our loan payment is due May 1st. So the day before that is April 30th. Okay? And we're going to be doing this by debiting interest expense by $4,000 and by crediting interest payable by $4,000. So what we did in the slide before is we recorded that we received cash for a loan, and then we're gonna, when the payment is due, right before it's due, we gotta record the interest that we have accrued. Okay, so the last record is that we have to record is when we pay back the loan. So this is how we pay back the loan. We know that we need to record the payment that is due May 1st because we were given 4 months to get this loan paid. So we need to record the loan amount plus the interest of the loan. Okay? So the loan was for $10,000 and the interest was for $4,000. So the total owed to the bank is $104,000, correct? So what we do to record the day that we make this payment is we need to debit notes payable by $100,000. Remember, we're paying it back, so we need to reduce that account because we no longer owe that $100,000. We're also going to be debiting interest payable because we are going to be reducing that account. We're going to be paying it off. And then we're going to be crediting our cash account by $104,000 because we need to take out that cash money out of that account to send it to the bank. And that is to record the payment to the bank that lent you the money. Okay? That's it for when you take out a loan and it comes with interest. It could also be applicable for your credit cards. Okay? So now, another string that is attached to sales for your business is sales taxes. And that is under sales tax payable. We as consumers pay taxes when we purchase goods. And that tax rate depends on where you live or where you have your business. Okay? So when you make sales, when you as a business owner have sales, you must collect tax for all of your sales. And you collect them and you send them to the tax agency ever so often. I think some businesses do it monthly. So in this instance, when there's taxes that are being collected, the business, your business, is only the collection agency for the taxes. You charge them, you collect them, and then you will send them to the tax agency. It's just holding them. And that's what it's called being a collection agency. So what I will show you is the way to record the sales and the sales taxes to collect the taxes, and then I'm going to show you how to record it when you're sending the taxes to the tax agency. Here we have a business with sales for $10,000 in this example. And we are told that the tax rate is 8%. This means that the sales tax for these sales is $800. Okay? And the way that you determine that is you put in your calculator 10,000 times 8% or 0.08 if you don't have the percent button on your calculator. So we have to record that we are depositing 10,800 in our cash account. Why? Because we sold $10,000 worth of sales and $800 on top of that was for taxes. That's what gives us our total for $10,800. So we record this by debiting our cash by $10,800 because we are going to be depositing the entire the entire amount of the sales and the taxes into our cash account. And then we're going to credit sales revenue for $10,000 and credit sales taxes payable for $800. That's how you're going to differentiate what was money for your sales revenue and what money is separated for sales taxes. Okay? And that is to record daily sales and sales taxes. Okay? Okay. So now you collected the taxes. Okay? So to record the transaction when the tax collected is sent to the tax agency, this is what we do. We debit the sales taxes payable by $800. So we're going to be reducing it. Okay? And then we credit our cash account by $800 because we're going to be taking out $800 out of our cash account to send it to the tax agency because that money does not belong to the business. The business just acted as a collection agency, collected it, held it, and now it's sending it to pay the taxing agency. And that's it for sales taxes. The last topic I will cover is payroll. And as a business owner, you may hire employees either full-time or part-time, and you may pay them on a salary basis or an hourly basis. But regardless of how they are hired and paid, the employer must also deal with another string that's attached. And this string is called benefits. So for example, I'm a full-time administrator at an education facility. I get paid on a salary basis. What this means is that I earn a set amount of dollars every single month, no matter if I worked 40 hours, 38 hours, maybe I called in sick the whole week, doesn't matter. Because me as an employee, I have sick leave, I have vacation time, so I'm gonna earn my full paycheck as long as I subsidize if I've been absent with either vacation or sick time. That's because I'm a salary employee. And since I'm a full-time employee, I have medical benefits, and the other thing is called fringe benefits. Fringe benefits are like workers' compensation, retirement, disability, etc. Okay? So what does this mean for the employer? I mean, not the employer. What does this mean for the employee? Okay? It means that if I, as an employee, earn $10,000 a month, I am not going to see $10,000 on my paycheck. I have to pay my share of fringe benefits. So in my example, I pay approximately 25% of my earnings towards fringe benefits. So I will have my gross earnings. Gross earnings is my salary base. Let's say I told you that I earn $10,000 a month. That's my gross earnings before any tax deductions, any payroll deductions. Okay? Then there will be payroll deductions. In this case, mine are totaling 25% for my fringe benefits. And so then I will get a check for net pay for $7,500. So for my example, it was gross earnings $10,000 minus $2,500 in payroll deductions, and my net pay was $7,500. Okay? Now, there may be other deductions such as union fees or donations, and it would all depend on the employer. Maybe they want to give some for money to charity, or maybe you have to pay extra if you have to have medical benefits for your family. All that eats away from um, your gross pay. So as you can see at the illustration here, your dollar is worth less and less every time you earn that dollar, depending if you have to uh, pay other taxes or deductions. Okay, so now what does that mean for the business owner, the employer? Well, most of the fringe benefits that I just mentioned to you will just be collected. Again, the business will just be the collection agent. But some of these fringe benefits, which I will explain a little later, must also be matched by the business owner or the employer. And this is because it's the law. And what those include, the ones that are by law that you have to match as an employer to your employee, is FICA taxes, federal income tax, and state and city income taxes. Okay. So I will just make sure that you remember it's FICA, federal unemployment, and state unemployment taxes. That's what the business owner is responsible for. So um, these three tax deductions or categories are also going to be an expense to the business owner, as I said earlier. So whatever the employee pays for that pay period or for that earning period that they earn that paycheck, the employer must also match the equal amount. And I'll explain that a little later. Okay, now another layer of taxes is the withholding allowances that an employee can claim. You as an employee will complete a W-9 form if you've worked for someone to declare your allowances or your tax exemptions. And you do that by stating if you are single and no children, or single with dependents, and you mention how many, or you may say that you're married but 0 children or 0 dependents, or you're married with a certain amount of dependents. It all depends on what you want to claim. The more withholdings that you claim, the less money that is taken out of your paycheck. And the less that you claim, the more that you get taken out of your paycheck. Okay? So what this chart tells you is, for example, if you earn between $500 and $510 for a specific pay period, and let's say you have 2 allowances, that could be yourself and a child, then the total withholding for that pay period is going to be $19. Similarly, if you claim that you have 4 exemptions and you get paid taken out $4, and as you can see, after 5 exemptions, nothing's taken out. Okay? Now, this will have an effect on how your taxes are completed, and it will determine if you will receive a refund at the end of the year. And that usually happens when you pay more than what you are supposed to pay, or you may end up owing Uncle Sam some money if you did not pay enough. That's why it's not that good to be claiming too many allowances, even though you have them, because you may end up owing money at the end of the year that you may not have available in your bank account. My example, I'm married and I have 2 children, so I could technically claim 4 exemptions, and I don't. I claim that I'm married and 0 exemptions. So that's kind of the reason I get a lot of taxes taken out, but I consider that like a savings account because I know that at the end of the year, I'm always going to be receiving a refund. So that's something for you to consider. Okay, so let's look at this example, which shows you what an employee's earnings and payroll deductions look like. So we have this employee worked a number of hours. I don't know how many, I'm just giving you an example. And those number of hours earned this person a gross earning of $552. But as an employer, as a business owner, I'm going to have to take out the FICA taxes, the federal income taxes based on the withholdings, state income taxes. This may be some kind of fund that this person may decide to donate to, and then it's a union employee, so they have to pay $5 a month for union fees. And all these deductions total $92.27. So the net pay or the check that you're going to be writing for that employee is not going to be $552. It's going to be $459.73. That is the sad reality of us thinking that we earn so much money a year, but we actually don't see that money because we have to take our payroll deductions. So we record the payroll expense as a business owner by doing the following. This is a different example. In this case, the salaries and wages expense was $17,210. Okay, it could have been for the month. Let's say this person earns a high paycheck every month. Okay, but we have to deduct the payroll deductions, and in this case it's FICA taxes, federal income taxes, state income taxes, and all that stuff right here. And so the way we're going to record the payroll expenses is by debiting the salaries and wages expense, what they have actually earned as gross earnings, and then you're going to credit all of the payroll deductions, all of them. Okay, and then you're actually going to put in a salaries and wages payable category as a credit, which is going to be the actual paycheck you're going to be paying your employee. In this case, $11,522.73. And what you're going to be doing next is you're going to be recording another transaction to record that check disbursement. So in this case, on January 14th, there was a check disbursed. So we have a debit for salaries and wages payable for $11,572.73 for this person. And we're going to credit our cash account because we're going to be taking out the cash of $11,522.73. And then the last thing that I need to talk to you about is, remember I told you that FICA taxes, federal and state unemployment taxes must be matched by the employer. Whatever the employee pays for the particular payroll, the employer must match it. And that's an expense for the business owner. And the way that it is recorded is in a separate transaction by debiting payroll tax expense for that specific amount, which is going to be equal to the total of sum of the FICA, the federal, and the state. And you're going to be doing those as credit. So if you add these three, it's going to be this amount here. And that's to record employers' payroll taxes. Okay? And that's it. That's all you got to learn for this chapter. And the last thing that I want to tell you is about W-2s that you know that you may receive if you don't own your business and you work for somebody. As a business owner, we have an obligation to submit a W-2 statement to each employer so that to each employee so that they can complete their taxes. And that is just going to be summarizing where they work, what they earned for the year, how much they pay for Social Security, Medicare, federal, social, Medicare, all that stuff. Okay, it will be stipulated here. And that's all that you have to learn for this chapter. We're done. Your homework assignment is just going to be determining some payroll for your employees. And that is all for this semester. All we have left is the the last test for chapters 8 and 11, the final, and the project. And I will be posting other information, a separate information email on those assignments. Thank you for taking my course. I hope that you have enjoyed it. And if you have any questions, please contact me. And I'll see you soon. Good luck.